Gold just ripped 40 pips against your position. Your stop hasn't hit yet, but your hand is already hovering over the mouse. Close it now. Move the stop. Add more. That moment, right there, is where most XAUUSD traders lose their edge. Not on the chart, in their own head. In this video, we're breaking down how traders who follow the ICT methodology actually handle emotional drawdowns on gold, one of the most volatile, most psychologically brutal pairs to trade. This isn't about indicators, it's about the internal system that keeps a trader functional when the account is bleeding red. Let's get into it. Before we talk psychology, we need to talk about why XAUUSD specifically wrecks people emotionally more than almost any other instrument. Gold moves in ranges that dwarf most currency pairs. A 100-pip swing on gold can happen in the time it takes to make coffee. The spread is wider, the wicks are longer, and the liquidity pools are deeper, which means stop hunts feel personal even when they're purely mechanical. ICT traders understand something early. Gold isn't reacting to support and resistance in the textbook sense. It's reacting to liquidity, the buy stops sitting above old highs, the sell stops sitting below old lows. Price is engineered to run through those pools before reversing. If you don't internalize that, every drawdown feels like the market is against you. If you do internalize it, a drawdown becomes something else entirely, a mechanical event you can read, not a personal attack. That reframe is step one, and it's not just a mindset trick, it's the foundation everything else is built on. Here's the core shift ICT-style traders make that separates them from retail traders drowning in gold volatility. They treat a drawdown as information, not as a judgment on their worth as a trader. A losing trade tells you one of two things. Either the setup was invalid from the start, or the setup was valid and the market simply ran through a liquidity pool before continuing in the expected direction. Most emotional damage happens because traders skip this distinction. They feel the red number and immediately internalize it. I'm bad at this. I always mess up gold. The market is out to get me. That internal narrative is what turns a normal drawdown into a spiral. The traders who last separate the outcome of a single trade from their identity as a trader. A drawdown is a data point. It gets logged, reviewed, and used to refine the model. It does not get treated as proof of anything about who you are. This sounds simple. It is not easy. It takes deliberate practice to build that distance between "this trade lost" and "I'm a loser." But that distance is the entire game. Emotional drawdowns usually don't start with the loss itself. They start with uncertainty about how bad the loss could get. If you don't know your maximum risk before you enter, your nervous system treats every tick against you as an open-ended threat. That's when panic kicks in, because panic is your body's response to an undefined danger. ICT-style traders remove that uncertainty before the trade even happens. Risk per trade is capped, position size is calculated off the stop distance, and the stop itself is placed at a structurally logical point, usually beyond a liquidity pool or a key swing point, not some arbitrary percentage. Once risk is defined and accepted before entry, the emotional charge of watching the trade play out drops significantly. You already know your worst-case outcome. There's nothing left to discover. The nervous system calms down because the threat has a ceiling. This is why traders who wing it on position sizing suffer far worse emotional drawdowns than traders who calculate risk mechanically every single time. The math isn't just about capital preservation, it's about psychological preservation too. Section 4. The narrative comes before the trade, not after. One of the most underrated psychological tools in the ICT approach is building a full narrative, a bias, an expected sequence of price delivery before ever clicking buy or sell. Why does this matter emotionally? Because when you have a pre-built expectation of how price should move, for example, expecting a raid on old lows before a move higher into a specific price target, you're mentally prepared for the drawdown before it happens. Compare that to a trader who enters a position with no real expectation of what price does next. Every wick against them is a surprise. Every surprise triggers a stress response. Every stress response chips away at their ability to think clearly. When the drawdown is expected, when you already told yourself, price will likely dip into this zone to grab liquidity before continuing, the same red number on your screen produces almost no emotional reaction. You saw it coming. It's not a threat, it's confirmation. This is why journaling your bias before the session, writing down the expected path of price, is one of the most effective defenses against emotional drawdowns that nobody talks about enough. Section 5. Detachment through process, not willpower. A common mistake is thinking emotional control is about gritting your teeth and not feeling the loss. That's not sustainable, and it's not what disciplined traders actually do. Real detachment comes from trusting a process so thoroughly that any single outcome becomes statistically irrelevant. If your model has been backtested across hundreds of gold sessions and you know your win rate and your average risk to reward, then one losing trade, even a painful one, is just an expected data point inside a larger sample. This is fundamentally different from hoping each trade works. Hope creates emotional investment in a single outcome. Statistical trust creates emotional distance from any single outcome because you already know that some percentage of trades we're always going to lose. That's baked into the model, not a failure of it. Traders who skip the backtesting phase never build this trust, so every loss feels like new evidence that something is broken rather than confirmation that the model is behaving exactly as expected. Section 6. The post-loss routine that prevents revenge trading. The most dangerous window for a gold trader isn't during the drawdown, it's in the 15 minutes right after the trade closes at a loss. That's when revenge trading happens. The account took a hit, the ego took a hit, and the impulse to win it back immediately takes over rational decision-making. On XAUUSD specifically, this is lethal because the next impulsive entry is usually sized bigger and placed with worse timing than the original trade. Disciplined ICT traders build a mandatory cooldown into their routine. After a loss, especially one that stings, there's a hard rule: step away from the charts. Some traders use a fixed time block, like 20 or 30 minutes. Others use a physical action, like closing the platform entirely and going for a walk. The point isn't the specific ritual. The point is interrupting the emotional loop before it can generate a second bad decision. A single loss is recoverable. A loss followed by an emotionally driven revenge trade is where accounts actually get destroyed. Section 7. Journaling as an emotional circuit breaker. Writing down what happened, not just the entry and exit price, but the emotional state during the trade, does something powerful. It externalizes the experience. When a feeling stays trapped in your head, it tends to loop. When you write it down, I felt anxious watching price approach my stop. I almost moved it. I didn't. You're now observing it rather than being consumed by it. Traders who journal consistently through drawdown periods report something consistent. The act of writing itself reduces the intensity of the emotion. It's not about analyzing performance after the fact, though that matters too. It's about the discipline of processing the experience in words instead of letting it fester as a vague, anxious pressure. Over weeks and months, this journal becomes a mirror. You start to notice your own patterns, which setups make you anxious, which mistakes repeat, which emotional states precede your worst decisions. That awareness alone prevents a huge percentage of future emotional drawdowns. Here's the uncomfortable truth about trading gold. The chart isn't actually the hardest part. Understanding liquidity, structure, and price delivery is a skill that can be learned in months. Managing what happens in your chest when the trade goes against you, that takes years. And most traders never build it because they spend all their time studying setups and none of their time studying themselves. The traders who last on XAUUSD aren't the ones who never feel the pull of fear or greed. They're the ones who built a system, predefined risk, a clear narrative, a cooldown routine, a journal that keeps them functional even when those feelings show up. The drawdown isn't the enemy. Losing control during the drawdown is.